Hello, everybody. This is Patrick MontesDeOca with the Equity Management Academy. This segment is brought to you by the IRA Advisor Group, securing your retirement in gold. We have the honor and pleasure to have with us today Mr. Rick Rule, founder and chairman of Sprott Global Resource Investments with more than $7 billion under management. Mr. Rick Rule has dedicated his entire adult life to many aspects of natural resource securities investing, and in addition to the knowledge gained in a long, successful, and focused career. Sprott U.S. Holdings is active in securities brokerage, segregated account money management, and investment partnership management involving both equity and debt instruments across the entire spectrum of the natural resource industry. Welcome to Trading Talk, Rick.
Thanks for the opportunity, Patrick. I enjoy it.
According to the latest data points, the U.S. has exported a massive amount of gold in January. I think it's close to about 500 tons, primarily to Hong Kong and Switzerland. Where is the gold coming from to meet such record demand?
I suspect there's continued disintermediation from places like GLD and perhaps from the leveraged long hedge funds that we have talked about in your earlier interviews. But the truth is, no one really knows. It brings up the question of why, when the German citizenry demanded the return of 1,200 tons of gold that the United States allegedly stored on their behalf, were they told that they would get some of their gold back, and that it would take 7 years to return that gold. The truth is, Patrick, I don't know the answer, and almost nobody in the world knows the answer. But it certainly is an interesting question, isn't it?
It just baffles me that this amount just continues to be exported. But let me ask you this. What is your opinion of Goldman Sachs calling gold to drop to $1,085 an ounce as a sure bet on the face of this record physical demand?
It reminds me very much of their call at $1,800 that it was going to go to $2,500. They are an extremely accomplished firm that is out of their element in gold.
In terms of, can you just describe what you mean by that, and maybe the difference between the paper market and the physical market?
Well, it would appear that when gold was in favor, the narrative associated with gold caused them to say that it was going to go from $1,800 to $2,500, precisely as it was topping. It would now appear that the Goldman Sachs people, at least regards to the gold market, are momentum players. The idea that most people have that the way that you make money in markets, including the gold market, would be to buy low and sell high, seems to be something that they've reversed if you look at their recommendations, which would be to buy high and sell low. Well, I have a lot of respect for Goldman Sachs, and I know a lot of people there, and while they have a lot of expertise in a lot of markets, their track record with regards to gold seems to be nearly unblemished by success.
Let's shift gears here for a minute and talk about interest rates a little bit, which may be I think a factor that's going to play part in terms of the gold market, and I want to ask you this a little further down the interview, a couple of questions about this. But why are the Feds tapering, which is another way of raising interest rates short term, on the face of a weak economy?
Well, I think the Fed's position is that the economy is recovering. But, of course, I don't believe that quantitative easing ever had to do with very much other than the fact that the Fed had to counterfeit, which is what I call quantitative easing, to make up for the difference between what the federal government spends and what it makes. You will recall that we had, quote, tax reform in the United States last year, which is a different way of saying that the president embarked on a populist scheme to steal more money from the most productive elements of society. And as a consequence of the fact that he has been able to steal more from the citizens, he needs to counterfeit less. tapering is just a function of the fact that he needs to counterfeit $10 billion a month less because he's stealing $10 billion a month more. Nothing more, nothing less.
You know, we've been hearing a lot about creating credit bubbles. Is stocks in a bubble, or U.S. stocks in a bubble?
I'm not so sure that U.S. stocks are in a bubble. I think we may have seen a bubble in certain sectors of the U.S. stock market. Biotechs would be an example. I'm not a general market securities analyst because I don't understand all those businesses well. But certainly when I look at random at the balance sheets and the income statements of the S&P 500 companies in the United States as an example, I see a fine collection of businesses. I see record high earnings, albeit with low interest rates and low cost of capital. I see pristine balance sheets. I actually see companies hiding cash on their balance sheets to appear to be less flush than they are. But I think you need to consider that these earnings and this balance sheet are taking place in a very low interest rate environment. And I am concerned about what would happen in the context of higher interest rates, where the cost of capital went up and where the capitalized value of the dividend yields went down. I'm not saying that this market's going to collapse. What I am saying is that these companies are existing almost in a greenhouse-style environment, where it would appear to me that it couldn't possibly get any better, and as a consequence, it might get worse.
According to web definitions, an economic bubble is trade in high volumes at prices that are considerably at variance with intrinsic values. It could also be described as a situation in which asset prices appear to be based on implausible or inconsistent views about the future. Does this describe clearly the present condition of the Feds and world central bankers when it comes to interest rates and the level of debt?
Oh, I think that's absolutely true. I think that the central bankers on a global basis have done a wonderful job of convincing a citizenry that was desperate to be convinced that liquidity was a substitute for solvency. The idea that increasingly insolvent central banks can pay record low interest rates when their ability to service the debts is at record low levels is implausible to be the most generous that I can be.
Is China in a bubble, Rick?
I don't think China is in a bubble. I think you've seen extraordinary examples of misallocation in China. Mm-hmm. You would expect that from an extremely powerful central government and a nascent market. One of the things that has always impressed me about the potential of China has been the accomplishment of Chinese people outside of China. When you make people more free, you make them more rich. I'm thinking back to 30 years ago when Deng Xiaoping said, "To be rich is glorious." All the Chinese have to do to fix China is nothing. I'm just not so sure that they have the courage to do that. Certainly a situation where you favor certain industries, where you allow rent-seeking, which is a favorite term for bribery and influence peddling, where you attempt to control an economy with 1.3 billion people, with a power structure on top of only 10,000 people, is room for disaster. You have to juxtapose that, however, against the incredible industriousness, the education-oriented elements of that society, the notorious aspirations for saving exhibited by that society. And I have to believe that in the intermediate and long term, I'm extremely bullish about the future of China. I suspect it will be said someday about China what has been said about the United States, which is that the Chinese often do the right thing when they're left with no plausible alternative.
How is a high interest rate environment going to affect the world stock markets, world economies, and the price of gold and silver moving forward from here?
Truly ugly. Initially when the cost of capital goes up, everything, including gold and silver, go down. You need to remember that ultimately the causes of high interest rates are good for gold and silver, But when you raise short-term and long-term interest rates, the holding costs associated with gold and silver go up, and the speculative sort of juices that fuel the greed side of the fear and greed duo that drive precious metals will be affected. But the truth is that we need an honest interest rate. We need an interest rate that rewards the savers in a degree sufficient to cause them to continue to forego consumption in favor of savings. And my own belief is that if going back to the late part of the decade of the 90s, that we would have taken our pill in the United States and allowed interest rates to rise, the same way that Volcker raised them in the early part of the 80s, well, we would have had a very ugly 2 or 3 year period, an ugly recession, that we would have come out of that with the same strength that we had as a country and exhibited in the early part of the 80s. We didn't do that. What we did is we really postponed the day of reckoning. But the day of reckoning will come at some point in time.
Can the world economies afford such a fundamental change, and what are the risks, particularly for developing economies?
Well, the world economy is going to have to. You can survive whatever is thrust upon you, and certainly as a species, we have had things like the Great Depression in the 1930s and World War II thrust upon us. It just will not be very pleasant. Listen, if you look as an example at the U.S. circumstance with $17 trillion in on-balance sheet liabilities and $65 trillion in off-balance sheet liabilities, the simple math argues for default. And there's two ways that you default. You can do it honestly, which is by, as an example, Patrick, your generation saying to mine, yes, you made all those promises to yourself, but you left us with the tab, and we're not going to pay you. Right. That Social Security that you didn't save for, you're not going to get. The Medicare that you didn't set aside money for, you're not going to get that either. If we were honest with each other, we wouldn't have a fiscal problem. We'd have social problems, to be sure.
Right.
But that's not what's going to happen. What's going to happen is that we are going to take the easy way out. We are going to default on the installment plan by using inflation to reduce the net present value of these unsustainable obligations, which is very unfortunate.
It seems that central banks, particularly U.S., Japan, have taken the path of currency destruction by printing record amounts of fiat currency in order to pay for its debt obligations. By historical standards, Rick, is this inflationary or deflationary?
Deflationary first, and then inflationary. The truth is that this incredible amount of money printing that's going on is really an attempt to shovel money in a deflationary hole that began to expose itself in 2008. And the truth is, on a global basis, at least in the advanced countries, we have made promises to ourselves that we can't keep. We have obligated society to bills on behalf of certain aspects of the citizenry that the rest of the citizenry cannot afford. So we need to obviate those bills. We need to default on those bills in some way, shape, or form.
Have we gone through a deflationary cycle, or basically we still have some pain to go through before we start to see or come out on the other side? Which is
I think that's right. I think that's right. I think we're having a war between inflation and deflation right now. In other words, we're having a war between the honest economics that defaulting on our obligation would bring, which is very deflationary, and the reorganization of society that's attempting to be affected by the central banks, where you forward shift the liability from my generation to yours. We're going to leave you with the bill, Patrick. That's the idea. The idea is that we're going to honor all the promises that we made to ourselves.
Thanks a lot.
And then, as they're carrying us out on the stretcher on the way to the ambulance,
yeah, I'll be right in the.
We're going to lift up the middle finger and say, "Thanks, Montes." You know.
What a good friend! What a good friend. How do you think precious metals, Rick, like gold and silver, will act in a deflationary environment?
Well, historically, as an example, in the deflation of the 1930s, they acted very well. What gold in particular has done, and to a lesser degree silver, is that it has formed for many societies in many times throughout history as real money, as a hedge against catastrophe, as a form of a storage of wealth that is at once a medium of exchange but also a store of value in itself. One of the problems that you have in deflation is that nobody trusts anybody else to pay. And money, cash, is really a promise. So if you accept it, you accept that the person who is obliged to you will pay you. Gold is not a promise to pay, Patrick. It's important that your readers understand this. It constitutes payment in and of itself, and it does well in periods of in periods of nervousness. I live, as you know, in North County, San Diego, and I'm very close to a community called Westminster, California, in Orange County, which is the home of 60 or 70,000 Vietnamese people. People that have the best recent experience in the United States of social chaos. And they're all gold bugs as a consequence of that social chaos. What happened in Vietnam wasn't inflationary, and it wasn't deflationary. It was merely catastrophic. The people who had access to gold were able to bribe themselves out of that catastrophe and into the United States. If you ask them the question about whether or not gold should be part of someone's portfolio, they look at you like you've lost your mind.
Yeah, it's a great example. I just got a couple of more questions, Rick. Can you comment on Russia and U.S. relations deteriorating over Crimea? And is this potentially a black swan in disguise?
I don't think so. I think this is a return to Cold War politics, which both countries understand extremely well. The really good news about where we are now as opposed to where we are then is that we're reliant on the Russians and the Russians are reliant on us. And the fact that we're reliant on each other lessens to a great degree the probability that we'll shoot each other, which I think is a good thing. Although, once again, I'm too old to have to fight the fight. That will be left to you. I would prefer that you provided the service that you provide yourself to mankind as opposed to being shipped east to shoot Russians. Now, will the dispute between us cause economic uncertainty and economic dislocation? Absolutely. Will we perhaps increase the level of sanctions that we have against the Russians? Absolutely. Will the Russians perhaps retaliate as best they can, although they don't have many ways that they can retaliate? Certainly. Will it be an inconvenience? Absolutely. 10 years from now, will it be anything more than a footnote in history if you are not Ukrainian or Crimean? Absolutely not. I don't see it. By the way, where we suggest that the Russians are actively manipulating Ukrainian politics and Crimean politics, Mr. Putin absolutely accurately points out that we have done the same thing. The soft coup that went on in the Ukraine with an elected politician was done very much at the urgings of the United States. I happen to believe that the United States in this instance is probably less evil than the Russians, but all of the hewing and crying that goes on doesn't seem designed to illustrate the fact that we are competing to see who is less evil as opposed to competing to see who is right. A pox on both houses.
Is the U.S. petrodollar in the middle of all this at risk?
Oh, no, I don't think so. Sprott has done a lot of work of late with very, very, very large Asian semi-sovereign investors. And what we have learned is that those investors see no substitute for the U.S. dollar. It is the deepest, most liquid, and most transparent market in the world. As much as the Russians dislike us, if you gave the Russians a choice as to what currency they would settle debts in other than the ruble, they would say the U.S. dollar. And if you ask countries outside Russia whether they would rather settle their debt in rubles or dollars, everyone will say dollars.
Now, moving on to your favorite subjects, have we bottomed in gold and silver mining shares, and what is your take on it, Rick?
I think we have, Patrick. Notice I said think twice, because one can never be certain. But the fact that we didn't see aggressive capitulation in those markets tells me that the recovery will be saucer-shaped rather than V-shaped. So I think that we're in for a 12 to 18-month gradual recovery before the bull market gets underway in earnest. We'll see higher highs and higher lows, to be sure, but we'll see 15 or 20% volatility. It was amusing to me to see the hope return to the junior mining sector in January and February with the market up by 25%.
Right.
And it was amusing for me to see the despair that set in when those markets gave back 10%. Right. You know, a market that's off 10% is 10% cheaper.
Yeah.
And the truth is that all of these advances need to back and fill. That's the way markets work. You need to consolidate your gains. So what's happening right now is absolutely expected and is absolutely healthy.
So buy corrections.
Absolutely. But most important, worry about stock selection.
Right.
Worry less about the market and worry much, much, much more about the companies that you talk about. Patrick, we've talked about this on your show before.
Yes.
The junior mining sector as a whole is valueless.
Right.
It has no value at all. Do not ever buy this market. You buy the best 10% of the companies in the market because they perform better than any other asset class in the world in recovery. The performance of the best 10% of the issuers in this market is so spectacular that it adds credibility and sometimes luster to a sector that is overall a disaster.
Rick, anything else you want to share with us in our audience?
Yeah, absolutely. I think in the context of resources, while I think that the whole sector will recover and recover nicely over the next 5 years, I would ask your audience, as I've asked them before, to ask themselves investment questions where the answer begins with when, not if. Find commodities for which there is ongoing demand. Find commodities where the utility to user is very high, and users will pay more if they have to. And find commodities where the selling price of the commodity on a global basis is less than cost of production. In other words, where the industry is in liquidation. If you do that, you'll find a commodity price that has to go up, not one that can go up. Do those commodities have names now? Yes. Water in the west and the southwest of the United States. Platinum and palladium on a global basis. And certainly uranium on a global basis. Will these commodities recover anytime soon? I don't know. But the answer to the question begins with when, not if. Very important.
Where can our listeners get in contact with you, Rick, if they choose to do so?
My favorite of all questions. North American, U.S. and Canadian listeners can get hold of us by telephone at 800-477-7853. And by all means, all of your international listeners should visit us on the web, www.sprottglobal.com. Look on the front page of that website where it says subscribe. Click subscribe. We will send you Sprott's Thoughts 3 times a week. The best opinions and information from the entire Sprott group. From Eric Sprott, from Dr. Mark Faber, from John Embry, from myself, and from the other analysts and portfolio managers that have made Sprott successful over 3 decades. All of it at a price I'm sure you will enjoy because it's free.
Rick Rule, once again, thank you for sharing this most precious time for precious metals. And until next time, my friend, you take care.
A pleasure. Thanks for the opportunity, Patrick.
Thank you again, sir.
Thank you.